Supplier contracts are entering a risk allocation reset. A quiet but measurable change is unfolding inside procurement departments. Environmental exposure is no longer addressed after a contract is signed. It is shaping how contracts are written in the first place. According to PwC's 2025 Global Investor Survey, 71% of investors say companies should incorporate sustainability-related risks directly into financial reporting, not just separate ESG disclosures. That expectation flows downstream. If environmental risk affects earnings, it must also affect the agreements that underpin cost structures and supply continuity. Deloitte's 2024 sustainability research found that 88% of executives rank ESG data quality as a top 3 challenge as companies grapple with the increasing regulatory and compliance demands of the evolving sustainability landscape, up sharply from pre-2022 levels. The same survey noted that supplier due diligence requirements have expanded significantly, particularly in sectors exposed to emissions reporting, chemicals regulation, and trade-linked carbon pricing. This is not a cosmetic shift. It is altering indemnification clauses, warranty language, audit provisions, and insurance thresholds. Carbon data plus costs. The European Union's Carbon Border Adjustment Mechanism, CBAM, illustrates the financial dimension. During its transitional reporting phase, importers of covered goods are required to report embedded emissions. The European Commission has made clear that the mechanism is intended to equalize carbon costs between EU producers and importers. When financial obligations begin to phase in, suppliers that cannot provide verified emissions data may directly affect pricing and competitiveness. As KPMG noted in a 2025 Supply Chain Advisory Report, carbon data integrity is becoming a commercial requirement, not a reputational preference. That statement reflects what procurement teams are seeing in practice. Environmental data is being incorporated into contractual representations because buyers cannot absorb exposure tied to inaccurate reporting. Legal practitioners are also observing the shift. In recent client briefings on ESG contract drafting, global law firms have cautioned that broad sustainability commitments without clear definitions or allocation of responsibility can create enforcement and litigation exposure. The recommendation: move from aspirational clauses to measurable, enforceable obligations. Chemical litigation and insurance coverage. That advice is landing at the same time as liability expansion in chemical litigation. PFAS-related settlements have exceeded $11 billion across major manufacturers. But the legal perimeter is not static. Downstream users, including industrial processors and waste handlers, have increasingly been drawn into claims, even when operating within regulatory limits. Moody's has described PFAS litigation as a credit-relevant risk for certain sectors, noting that prolonged remediation timelines and settlement structures can materially affect leverage metrics. When environmental liability becomes credit-relevant, it inevitably becomes contract-relevant. Insurance markets add further pressure. Swiss Re Institute's 2025 Sigma report estimated approximately $137 billion in global insured losses from natural catastrophes in 2024, continuing a long-term upward trend. Insurers are responding with higher deductibles, tighter environmental exclusions, and more stringent underwriting. Marsh's Global Insurance Market Index has highlighted continued volatility in casualty and specialty lines, including environmental liability, as insurers reassess exposure in high-risk industries. Procurement teams are reacting by requiring suppliers to carry higher pollution liability limits, provide detailed certificates of insurance, and accept clearer indemnification triggers. Coverage terms that once sat unexamined are now negotiated in detail. Energy volatility is compounding the recalibration. The International Energy Agency, IEA, has repeatedly emphasized that while renewables are expanding rapidly, price volatility in fossil fuel markets continues to affect industrial cost bases. Suppliers operating in energy-intensive sectors face variable input costs that intersect with carbon pricing and emissions reporting obligations. The result is a contract environment where buyers are asking questions that rarely surfaced before. If emissions reporting changes mid-term, who absorbs compliance cost increases? If carbon pricing expands to new jurisdictions, is there a price adjustment mechanism? If environmental disclosures are restated, does that trigger indemnification? These are not abstract hypotheticals. They are appearing in draft agreements. What investors need to know about supply chain exposure. BlackRock's 2024 Investment Stewardship Report emphasized the importance of board oversight of material climate and supply chain risks, noting that insufficient risk management can affect long-term shareholder value. When institutional investors connect supply chain environmental risk to long-term valuation, procurement clauses become part of enterprise risk management. None of this means suppliers are simply absorbing all liability. The UN Global Compact's Responsible Contracting Initiative encourages companies to integrate sustainability obligations into contracts in ways that are practical and implementable, rather than relying solely on one-sided risk-shifting clauses. That nuance matters. The goal is not maximal risk transfer. It is clarity. What does all of this mean for procurement teams and contracts? Contracts are evolving from transactional documents into instruments that define how environmental exposure is shared, priced, and monitored across the value chain. In practical terms, procurement teams are embedding carbon and chemical data representations as enforceable warranties, linking audit rights to environmental performance, revisiting liability caps in light of litigation expansion, coordinating closely with finance to align contractual exposure with reserve modeling, requiring insurance coverage that matches realistic environmental risk. This is not about ESG branding, it is about financial exposure management. Supplier contracts are becoming the front line of environmental risk governance. The negotiation table now determines not only cost and service levels, but also who carries the consequences when regulatory standards tighten, litigation expands, or environmental data fails to withstand scrutiny. Procurement is no longer negotiating only supply. It is negotiating certainty. You've been listening to Sustainability Soundbites by Environment and Energy Leader. For partnership opportunities, please reach out to our team.